Welcome to Chapter 5, Recognition and Derecognition. To be very straightforward about it, recognition is saying hello, while derecognition is saying goodbye. But then of course the conceptual framework has its own way with words, and has therefore defined recognition as follows. Recognition is the process of capturing for inclusion in the statement of financial position or the statements of financial performance an item that meets a definition of one of the elements of the financial statements, an asset, liability, equity, income, or expenses. Recognition involves depicting the item in one of those statements, either alone or in aggregation with other items, in words and by a monetary amount, and including that amount in one or more totals in that statement. Whoa, that was a mouthful. To simplify, recognition simply means including an element in the statement of financial position or the statement of financial performance when it so qualifies. And when does it qualify? Well, when it meets the definition of the particular element, say for example the definition of an asset, and when it provides users with fundamentally useful information. And when do you say that information is fundamentally useful? Chapter 3 had the answer: relevance and faithful representation. But what if it has met the definition of an element, but it does not necessarily provide relevant information? For example, it meets the definition of an asset, but it is uncertain that the asset exists, or that the probability of an economic inflow is low. What happens then? Well, the asset will not be recognized. This is what was referred to in Chapter 3 as unrecognized assets and liabilities. Go ahead, feel free to review Chapter 3. And the typical location for these unrecognized assets and liabilities is in the notes to financial statements. But what happens if faithful representation is the one affected? Say for example, an item meets the definition of an asset and is considered relevant, but you doubt if it can be faithfully represented. We have to remember that before an item can be recognized, it has to be measured. Now, what if this item encounters a very high measurement uncertainty? It is to be pointed out at this point that there are items in the financial statements that use estimates. We've all encountered estimates in accounting, right? And there's nothing wrong with that. Even the framework recognizes that the use of reasonable estimates is an essential part of the financial statement preparation. So I guess it would be safe to say that the problem with this will only arise if an estimate cannot be reasonably made. In such case, the item with a very high measurement uncertainty cannot be recognized. But remember, this will only be the case if it is close to impossible to come up with a reasonable estimate. Speaking of recognition, how many times have you encountered the phrase carrying amount? Do you know that it simply means the amount at which an asset, liability, or equity is recognized in the statement of financial position? Pretty cool, huh? Anyway, a long time ago, when accounting was fun and simple, your fundamentals of accounting instructors must have said that the financial statements are interconnected. The framework points out that the financial statements are linked because the recognition of one item requires the recognition or derecognition of one or more other items. Sounds complicated when stated that way, but this is very well illustrated if you simply talk about or think about the double entry system of accounting. Remember debits and credits? The interconnectedness among the financial statements can be demonstrated by looking at the movements in net assets or equity for a period. You see, here you have your equity at the beginning of the period, and right here you have your equity at the end of the period. A lot is expected to happen within the period. For example, the entity could have enjoyed a profit or suffered a loss. There could have also been contributions made by and distributions made to equity holders. It is these movements that make our ending equity the way it is. Needless to point out, equity is reflected in the statement of financial position, but income and expenses are found in the statement of financial performance. So you see, interconnected. Alright, since we have already talked about saying hello, let's now talk about saying goodbye. That is derecognition. The framework defines derecognition as the removal of all or part of a recognized asset or liability from an entity's statement of financial position. Accounting normally says goodbye to an element of the financial statement when it no longer meets the definition of that element. For example, you have lost control over your asset because you sold it. You have to derecognize. Or you have already paid your liability, thus you no longer have a present obligation. You have to derecognize. However, at times, we derecognize only a portion of the element, such as, for example, we have only paid a portion of our long-term debt. The portion that we have derecognized is called the transferred component, while the portion that is left in the financial statements is called the retained component. So there you have it. Hellos and goodbyes. Recognition and derecognition. Whenever you're ready, I'll see you in Chapter 6, Measurement.